Of course, actives continued to be deep in the negative as well. Sonia.
Absolutely. And for now, up until now, at least the market was trending in the green, right? I mean, the Nifty was up about 3% for the year. On Friday, the Nifty as well moved into negative territory. So now we're neutral for the year, down about 0.5% or so. But still not as bad as most markets. In any case, let's kickstart the show and tell you what you'll get to see in the next 2.5 hours. First up on the equities front, Chetan Seth of Nomura says that the Fed's continued hawkish stance is creating pressure points which they think are not conducive for Asian equities. Indian and ASEAN countries have been places where investors have been hiding, but they think the room to hide in these places is also narrowing rapidly, with valuations particularly stretched in India, which is 21 times forward price to earnings and 3.2 times price to book. For now, they continue to think in Asia, defensives, quality or even value and local idiosyncratic themes and EVs, renewables, especially in Korea, may provide some relative safety.
Let's get you some money market views. Then B. Prasanna of ICICI Bank says that dollar strengthening across the board, backed by the extremely hawkish outcome of FOMC, is the theme. Emerging market currencies came under pressure from capital outflows as risk assets sold off. Rupee saw volatile adjustments after the RBI let rupee trade beyond the psychological level of 80 in the coming week. Expect rupee to trade between 80.75 to 81.75 amid global risk of sentiment, with RBI protecting the currency from a sharp depreciation move. So let's see if that range holds or not.
I think that was a big theme last week, right? The RBI intervention at 80.8 and sort of protecting the currency at that level. Well, for today, on the bonds, B. Prasanna says that global yields are repriced significantly higher owing to the higher, faster, longer theme by global central banks. Domestic yields followed suit, expecting higher terminal rates in India as well. The impact was more pronounced on the OIS market as bonds continue to witness optimism around the global bond index inclusion. The coming week is an event-heavy one with the MPC, the second-half borrowing calendar and the announcement of the global index review. He expects the markets to remain volatile, ranging between 7.2 to 7.5 on the 10-year benchmark yield.
Okay, those are views across asset classes as always. Let's get some opinion in straight on the top of the show. Taimur Baig is Managing Director and Chief Economist at DBS Group Research. And we have Mark Matthews of Bank Julius Baer and Company joining in as well. Gentlemen, great to have both of you here. Thank you very much. Taimur, let me begin by asking you, India has been in a way so far Teflon coated, right? Whatever is happening in the rest of the world has had little impact. At least if you judge by outcomes. Beneath the surface, I'm assuming there is a lot of tumult. Is that coating going to sort of wear off a little bit, Taimur, as global risk-off continues? What's your opinion?
Good morning. I think that the turbulence in the emerging markets has a long ways to go. And the fact that the Indian rupee has outperformed, or the Indian markets on a net basis this year has received flows, these are good markers to keep in mind that, India may still on a relative basis do well, but on an absolute basis, there is no silver lining. We have very, very difficult fourth quarter coming for us. And whether it is the INR, or you go to Indonesia, IDR, or you go to Brazil, the Brazilian currency, real, everything is going to come under pressure with this relentless rise in Fed interest rates and the extraordinary strength in the US dollar. I can't remember whether it was Anuj or Prashant who said that, we haven't really seen this sort of year-to-date performance of the US dollar. Absolutely correct. I think over the last 50 years, we may have had 2 years when we've had the DXY appreciated by more than 20%. And this year we're heading in that direction. And that sort of seismic move of the key reserve currency of the world will come with massive amount of stress for the rest of the world, whether it is for debtors or it is for equity holders. Bad times are not coming to an end anytime soon.
Okay, that's an important point. Mark, good morning. So far, the Indian market has been quite resilient and has sort of survived this global mayhem. And we actually had seen money chasing Indian market as well. But off late, during the last 1 week, there's clear evidence of that money also deserting us, and the way dollar rupee has shaped out and the way the market has been playing out the last couple of days. Do you reckon that the Indian market might give up the recent outperformance?
No, I don't think it will. I don't think the Nifty will come down because, number one, there's too much local money on the sidelines that wants to buy it when it does correct, because the locals can see that the domestic economy is very strong and there's a big capex cycle that's just started, which will be financed by the banking sector, which is the biggest part of the index. And the second thing is, unlike the lead up to the global financial crisis, where you had billions and billions of dollars of foreign money going into India, up until last year, foreigners were consistent net sellers of India, and even well into this year. So even if they are bearish and want to take profit on things, they don't have a lot of India to take profit in.
Okay. Taimur, good morning. I want to come back to that point you were making about how it's going to be rather tough for equity markets, or rather markets overall, in the emerging space. We have the RBI policy coming up on Friday. The street is expecting, I think the consensus view is a 50 basis points rate hike. How are you going into it, and what is the kind of commentary that you expect from the governor?
Good morning, Sonia. Yes, Radhika Rao, our India senior economist, and I also believe that a 50 basis point hike is very much on the cards. For the RBI, you can see in their game book, you can see what they have been doing over the last month or so. They are worried about incipient inflation pressure. They're worried about the rupee depreciating on a disorderly manner, although relative to other currencies, it hasn't really depreciated that much. But those sort of things don't make a central bank comfortable. They do probably feel that real interest rates should be higher. They feel that the output gap from the COVID crisis has narrowed substantially. And it's not just a question of importing inflation. There are domestic drivers of inflation as well. So from that perspective, I think the RBI is doing in the right direction. It's time to take some of the froth away from the economy, be it from the financial markets or from the relentless strength in consumption that we have seen so far.
No, absolutely. Mark, just a quick point. I mean, you've been you've said this, I think, 2 or 3 occasions when you've been on the program that, you know, eventually we'll probably have a Goldilocks kind of scenario, and you know the market, at least in India, seems to be sensing that. Is that do you kind of hold that view, or has that changed? That has anything changed there? What's your sense, Mark?
Prashant, I was hoping you weren't going to bring that up, but since you did, you've got a good memory, sir. I was wrong. I thought that Powell was going to be bearish at hawkish Jackson Hole, which he was, but I didn't understand the magnitude of the hawkishness nor the follow-on in last week's Federal Reserve Open Market Committee meeting, and specifically the adjustment of the dot plot, which infers a terminal rate of 4 3/4 pretty rapidly, and so that's not something I saw. All I can say is that I think inflation is coming down. If you look at used car prices, the oil price, property prices. I was just chatting with a friend over the weekend who's in the food business. He said the harvest in the Northern Hemisphere will be good this year, and there's plenty of containers where they can put the food on. So I believe the inflation will come down, and the Fed won't have to raise as much as it's saying it will. But the market is once bitten, twice shy, and it's not willing to believe that. And so the Fed has got the ball in its court, and therefore I can't really say that we're heading into a Goldilocks scenario anymore, because eventually we will get lower inflation, but I think it's probably a good, at least 3 months before we've got the tangible evidence of that in the actual CPI and PCE numbers, and that's a lot of time for the market to have to withstand in a bad mood like this.
Okay, okay, fair point. Mark, just coming back to the question I asked you, I know there's a lot of local money waiting to buy, but the sheer force of FI selling, do you think that could increase from here on if global ETFs start to sell? I mean, that money chases momentum only, right? I mean, it doesn't care about macros as much.
One thing I find very weird about this year is that we have not seen more downside in a few of the emerging markets, for example, India, but also Indonesia and Brazil. There's a few others. And so I guess what I want to say is that either people don't own it and so they can't sell it, or if they do, they just really want to hang on to it for whatever reason. You have to remember China is really not in the equation anymore. So if you want to have some allocation to emerging markets, you're left with quite a small handful of large liquid markets, of which India is the biggest. So my hunch is that even if the the sentiment deteriorates globally, you won't see that big outflow that you were asking about.
Okay. So the big outflow perhaps is not coming. In any case, most global markets like the Dow, for example, is virtually in a bear market right now. I mean, it's down almost 20% this year. So perhaps a lot of people didn't see that coming, but it is what it is. Taimur, what are your thoughts on the currency? Because over there as well, right? The rupee has been roiled. We're at 80 plus. There was some intervention by the RBI last week. But your thoughts on how it may shape up for global currencies, including currencies like the rupee?
So yeah, I'm very worried about the fourth quarter. I mean, my fear is that the Japanese yen being the canary in the coal mine heading toward 145 and beyond, and if it goes past 150, there'll be a wave of depreciation pressure in the region, starting with the RMB and North Asian currencies, but then falling into ASEAN as well as South Asia. Look, we've had emerging market crises in the past around Fed rate hike cycles. You could argue that there are parts of emerging markets that have better fundamentals. You could also very convincingly argue that India probably falls in that relative stronger cohort. But the wave, the tumult that's coming is going to affect everybody. It's just a question of which degree. And I guess that's where the importance of having good fundamentals come in, that your relative outperformance will help you. But at the same time, it's not like, there is no external currency borrowings by Indian companies. It is not like the fact that Indian private capital market is not reliant on foreign inflows. They are, and these are secular negative forces that are percolating around the world. As much as India's relative fundamentals are better, I don't think India will be immune from that at all. So we need to fasten our seatbelts.
Okay, fasten our seatbelts. I guess that sums it up, right? For the rest of the year, things may look a bit ugly. But thanks a lot, Mark and Taimur, for joining in. So that's DBS, quite cautious, I must say. The most cautious I've heard them in a while. They say that emerging markets have perhaps a lot more to go in terms of pressure, and not just for equities, but for the currency market as well.
Taimur said, I think right at the beginning, the first answer he said, the relative outperformance may still continue as compared to emerging markets because it's the best placed. I mean, the market here seems to be the best placed. But on an absolute basis,
absolutely,
you have some downside,
some
maybe.
pressure.
So relative outperformance,
I think that point is taken because, what was happening was the assumption was made that US, what is decoupling? That the US market will fall 20% and our market will rally 20%. That will not happen. Like Rhythm also said, you're never fully decoupled. You fall less. If there's a massive global risk off and the global market falls 20-25%, maybe you fall less. Like
Which is not a bad scenario.
We've fallen 7%. I mean, if you take from the peak, we are down 7%. The US market is down some 20-25%. So I think that itself is decoupling.
And I've also seen many comparing the S&P and the market here. But but when you compare returns there year to date, for example, so S&P is down 20-22%, and the market here is down 1%. But actually, in dollar terms, we are down 8%. Year to date, and so the gap is not
that wide.
That wide. It is wide. It is still wide, and that may come off a little bit, but it's relative and absolute. And I think that point.
And just one last point: if you take the broader market, and in broader market, if you look at the number of stocks below the 50-day moving average or below the 200-day moving average, we're actually in our Nifty Junior or mid-cap and small-cap index, we are very close to what the US markets have done in their own Russell 2000 and Russell 5000. So I think in the broader market, it's still intact. It's just that on the Nifty, there are a few large stocks which are sort of masking the bigger
the pain. Okay. All right. Let's do one thing. We will talk about all of these stocks on the other side of the break, so don't go anywhere. Our entire research team will be with us to help us track the action as we begin this week. Our top 10 segment coming up. We're looking at names like Britannia, Lakshmi Organics, Natco Pharma, Suzlon Energy.